So today we want to look at taxation of long-term construction contract. So taxation of long-term construction contracts. Mlisema mjafanya hiyo kweli? So taxation of long-term construction construction ama mlifanya? Kuna watu wengine wamepotea wamekuja leo. Construction of taxation of construction of long-term. Tunaenda kuandika, we are writing very brief notes and then we do questions. So you can write these are contracts. These are contracts. These are contracts which takes more than one accounting period. Which takes more than one accounting period. Before completion. Before completion. So the income is determined on annual basis. The income is determined on annual basis. The income is determined on annual basis for each contract. For each contract. And then you write another point. Another point. So there are two approaches. There are two approaches. There are two approaches used to determine taxable income. Used to determine taxable income. Used to determine taxable income. So number one is what we call the degree stroke percentage of completion method. Number one is degree stroke percentage of completion method. Degree stroke percentage of completion method. Degree stroke percentage of completion method. Number two, where work certified, certified is considered as value of sales. Is considered as value of sales. So let us look at number one, percentage of completion method. Percentage of completion method. Percentage of completion method. Percentage of completion method. And then you write under this method, the revenue and the profits, is determined as the contract progresses. Is determined as the contract progresses. Is determined as the contract progresses. The degree of completion is determined as follows. Degree of completion is determined as follows. Percentage of completion or the degree of completion is equals to cost incurred to date. Cost incurred to date. Cost incurred to date over is total estimated cost. Total estimated cost times 100. Times 100. Percentage of completion is equals to cost incurred to date over total estimated cost times 100. And then we have revenue recognized. Revenue recognized is equals to percentage of completion times contract price. The revenue recognized equals to percentage of completion times contract price. And then the profit statement here, profit statement is equals to revenue recognized minus cost incurred to date. Cost incurred to date. And then you get the gross profit minus allowable expenses less allowable expenses. Less allowable expenses, and then you get the so you're saying there are two approaches to determine taxable income. So there's a degree of completion, and there's where the value of work certified is considered as revenue. So let's look at the first one, May 2012, question number 2. 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 Excuse me, May 2012, question number 2. So the question reads, are you there? The question reads, Ujenzi Contractors is a firm engaged in property development. During the year ended 31st December 2011, the firm secured 3 construction contracts, namely X, Y, and Z. The firm computed taxable income from the contract on the basis of percentage of completion method. The information relating to the 3 contracts is as follows. Contract price for X, 1,200, Y, 1,800, 2,000 for Z. Cost of work certified to date, 400, 720, and 1,200. Estimated cost of completion, 440, X, 560Y, 200Z. Additional information number 1. The total allowable expenses for the year ended for the 3 contract amounted to 500,000 shillings. The firm allocates expenses on the basis of the contract price. Number 2, the firm received interest income on housing development bond amounting to 960,000 shillings during the year. Number 3, the firm also received dividends from investing amounting to 1,360,000 gross. So required, determine the following for each year ended at 1st December 2011, taxable profit or loss for each contract, 6 marks, total taxable profits or loss for the firm, 2 marks, and the tax liability, if any, for the firm. So here we have 3 contracts, isn't it? So we're going to write Ujenzi Contractors Limited, computation taxable profit. So here we have X, Y, and so that we have 3 contracts, isn't it? So we're going to first of all to determine the percentage of completion. So we have the value, cost of work certified to date. Cost of work certified to date. Cost of work certified to date. X how much? 400. Y? And this other one? And then we have estimated cost completion, isn't it? Estimated cost of completion. Estimated cost to completion. Estimated total cost to completion. X how much? 440Y, 560, and Z 200. Then we get the total cost. We get the total cost. This one is 840. 1280, and this other one 1400. Then here we determine the percentage of completion. Percentage of completion. So percentage of completion, we said, is a cost incurred to date over as total cost. Here it is going to be 400 over 840 times 100. This one is going to be 720 over 1280 times 100. This is going to be 1200 over 1400 times 100. So the first one, how much you get? 47 point. So this one is going to be 48%. So this one is going to be 56%, 86%. Then now we get the revenue recognized. We get the revenue recognized. Revenue recognized. Revenue recognized, it is 48% of contract price. Contract price for contract X is 1200. 576. This other one? 1008. This other one is 17. So that is the revenue recognized. Revenue recognized is the the percentage of completion multiplied by the contract price. Then you less cost incurred to date. Cost incurred to date. Cost incurred to date here is 400. This is 720. This is 1200. And then you get the gross profit. 176. Two. So this is 288, and the other one 520. Then we less allowable expenses. We less allowable expenses. We less allowable expenses. Allowable expenses. So the cumulative for all the contract is 500. So they are sharing on the basis of the contract price. So we get the total aggregate of the contract price for all the three contracts. So that is 1200 plus 1800 plus 2000. So how much do you get? 5. So the first one, you're going to take 1200 over 5000 times 500. So this one, I'm going to deduct 120. The second one, you're going to take 1800 over 5000 times 500. So the next one will be 180. And then the third one, the last one, to be 2000 over 5000, 200. And then you get the taxable profit. You get the taxable profit. So this one is 56, 108, 320, isn't it? Yes. So we get here to total taxable profit. Total taxable profit. Total taxable profit is going to be 56 plus 108 plus 320. It gives you how much? 408.84. Then we have other incomes. So we add other incomes. Other incomes. Other. So they have interest income. Interest income, the withholding tax for companies not final. So you add their interest income. It is given in its gross form. Interest income, how much is it? 960. Dividend income from investment withholding tax for final. Then we get the total taxable income. Total taxable income. Total taxable income. 1444. And then here we determine the tax liability. Tax liability is going to be 30% of 433. So that is how we do for percentage of completion. Though we have another question that you're going to attempt after we've done the other method. After we've done the other? Yes. So this one you can take a photo of it, or you can, which one is best preferable? You write a little bit and then you finish and go. Or you have a question, anyone have a question? So now we want to look at another one where the value of work certified is considered as so right there, where work certified is considered as value of sales, where work certified is considered as value of sales, and then you open December 2024, question number 5D. December 2024, number 5D. So right there, where work certified is considered as value of sales. Where work certified is considered as value of sales. December 2024, question number 5D. 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 December 20. Atax Contractors Limited has been in construction business for many years. The following information relates to one of its construction contracts for the year ended at 1st December 2023. So we have balances as at 1st January 2023, material on site, 30,000, accrued wages, 2,000, rent prepaid, contract related, 4,000, planned written down value, 20,000. Transaction during the year, material sent to site, planned purchased, wages paid, inspection fees, subcontractors fees, consultants fees, material sold, casual labor, head office expenses, depreciation in bracket provision, rent paid, non-contract related, 8,000, other expenses allowable, value of work certified in the year. Cost of work uncertified, 20,000, cash received from clients, 80,000. Balances as at 1st December 2023, material on site, 50,000, wages accrued, 4,000, rent accrued, contract related 5,000. Additional information number 1, investment allowances agreed with the Commission of Revenue Authorities at the rate of 10% on plant. Number 2, the company's policy recognizes 2/3 of annual profit when they arise for tax purposes. And number 3, any contract losses are recognized in full in the year of their occurrence. Required: 1, compute contract profit or loss for the year ended at 1st December 2023 for High-Tech Contractors Limited, 6 marks. 2, determine taxable profit or loss for the year ended at 1st December 2023, assuming that there were no other contracts. So we're going to write the name of the company. It's called High-Tech Contractors Limited. Contractors Limited, taxable of profit or loss for the year ended, for the year 2023. So we said value of work certified is considered as sales. So write your shillings and thousands. So value of work certified, isn't it? So value of work certified. Value of work certified 120,000. Can you everybody see that amount? Then now we less allowable expenses. Those expenses that were incurred in doing that work, material and other expenses. So we start with less allowable expenses. With less allowable expenses. So we start with the material cost. So we have material, we have the balance brought down, the one that was there at the beginning of the year. Balance brought down. Balance brought down of material is 30,000. Can you see it? So 30,000, that is a balance brought down. Then we trace any other item or other information on material. Transaction during the year, material sent to site. So we have sent to site. Material sent to site. How much is it? 100,000, isn't it? We have another material sold. We have material sold. How much? 1,500. So that one we deduct. Material sold 1,500, we deduct. They are on the site, and then part of the material was sold, isn't it? Yeah, so that one you deduct. Any other thing on material? Material balance carried down, which is 50,000, and then you get the material consumed. So material consumed. How much is it? Excuse me. So this is 78,500, isn't it? Then other allowable expenses. Planned purchased. Planned is a capital item, isn't it? So that one is not allowable. Then we have wages. So wages is allowable, isn't it? So we have wages. So the wages that was paid, is it 8,000? 8,000. It has some adjustments. Accrued wages at the beginning, we subtract 2,000, and then we add at the end, which is 4,000. So how much do you get? Is it 10? So the wages will be 10,000. So you adjust if there is adjustments, of course, accruals or prepayment. Then the next item is inspection fee, allowable, isn't it? Inspection fees. 2. That one is allowable. Then we have consultants fees. We have subcontractors fees. Subcontractors fees, 1,000, allowable, isn't it? No adjustments. So we write it the way it was. Material sold, consultants, isn't it? That one is also allowable. Consultancy fees. 3,000 consultants fees. Material sold, that one I've already dealt with it. Casual labor, allowable. Casual labor allowable. Casual labor allowable, how much? 2,000. Head office expenses allowable. Head office expenses. How much is it? 3,000. Depreciation provision, disallowable. Rent paid, non-contract related, disallowable. Other expenses, other expenses. Other expenses, how much is it? 2,000, isn't it? Then we have, at the beginning, we had rent paid, contract related, isn't it? So we had accrued balance brought down, isn't it? So we have rent, accrued balance brought down, we normally add. So 4,000. And then we have accrued at the end. How much? 5,000. Oh, prepayment. Yeah, prepayment at the beginning, we normally add. And then we have accruals at the end, we also add, isn't it? So now the total will be how much? 9,000. Is it equal? Co-contract related, isn't it? Tumeona hiyo. Then we have investment allowance on plant. Investment allowance on plant, 10%. The written down value at the beginning was 20,000 plus another one that was acquired during the year, 10,000. So that one gives you, is it 3,000? Yes? Yes. So we add all the costs. We add all the costs. One thirteen, 113,500, isn't it? Then here we have profit. 6,000. This is 6,500,000, isn't it? So that is number one, is done. Then now here we come here, get the cost of work certified. Cost of work certified. Remember, this was value of work certified. This is the cost of work certified. So that one, you take the total cost, which is it's equals to total cost minus cost of work uncertified. Cost of work uncertified. Hiyo ni ngapi? So total cost ni 113,500 minus 20,000. So how much do you get? 93. Then here we have recognized taxable profit. Recognized taxable profit. Recognized taxable profit is going to be the cost of work certified. That is 93,500 over cost of work certified plus cost of work uncertified times contract profit, which is 6,500. So to get the recognized taxable profit, you take the cost of work certified, which is 93,500, over cost of work certified plus cost of work answer times profit. So how much do you get? This is taxable profit, not this is a taxable profit, not recognized. Taxable profit. That one will be the taxable profit. $53, $54. 53, 54.6, isn't it? Then here we have the recognized profit. Recognized profit. They say they recognize how much? A third of 53, 50. Is it 54? 53, 54.6. Nakuja ngapi? Two-third. Nakuja ngapi? 35? 6569.75, isn't it? Yes, so that is how it is done. So now for you to get if you are given in a question that a particular percentage, like this one you have been told, the company policy recognizes two-thirds of annual profit when they arise for tax purposes, isn't it? So first of all, you'll determine the cost of work certified. That is different from the value of work. So we have the cost of work, sir, which is the total cost minus and cost of work and certified. Then taxable profit. Taxable profit will be the cost of work certified over cost of work certified plus cost of work uncertified times profit, this one. Then now you take that particular ratio that you have been told as recognized profit. Yes, so we want to do another one of this kind. So you can do very fast, move on to another one. So it's a matter of listing down the expenses. Let us look at another question. November 2019. November 2019. November 2019, question number 5, 4C. November 2019, question number 4C. November 2019, question number 4C. November 2019, question number 4C. So November 2019, number 4C, the question reads, Benita Contractors Limited operates in the construction industry. On 1st November 2016, the company won a tender for the construction of 2 projects, a hospital and an office complex. Construction of the project commenced on 1st January 2017, and the following details relate to the 2 projects for the year ended at 1st December 2018. So we have hospital projects and office complex. Material, accrued salaries and wages, that is at the balance board down. We have cost of work done, value of work certified to date. Value of work certified to date. And then we have material delivered on site from store, from suppliers, plant purchased at cost, subcontractors fee, consultants fees, inspection fees, salaries and wages, head office expenses, material transferred out, material sales, plant lease charges, direct expenses, cash received from subcontractors, cumulative value of work certified as at 1st December 2018, value of work uncertified in the year, balance carried forward, material on site, accrued wages. And then additional information, number 1, consultant fees for the hospital project include 40,000 prepaid for the year 2019. Number 2, wear and tear allowances on plant was provided at the rate of 12.5% per annum. It was 12.5% then, but nowadays it's 10%. Then number 3, directors' expenses accrued and not reflected above were as follows. So we've been given the balances. They are required. A schedule showing the taxable profit and tax payable, if any, to Benita Contractors. So we're going to write up Benita Contractors Limited. Benita's Contractors Limited. Computation of taxable profit, stroke loss for the year ended, 31st December 2018. So here we have hospital project. Hospital project, shillings and thousands. And then here we have office complex. Office complex. So we've been given, this work started in 2017. The projects, all of them started in 2017, but the current year is 2018. The current year is 2018. So we've been given the cumulative value of work certified, cumulative. So meaning the current year and last year. So we have value of work certified here. So value of work certified, isn't it? So cumulative amount here is how much? 700,000. This other one is 60. Then we have been given the balance breakdown for last year's only. Value cost of work done, isn't it? Value of work certified to date. So that is at the beginning of the year. So that one is, so we less value of work certified, balance brought down. So this one is how much? 200,000, and this other one? So we deduct amounts. This is the balance brought down. This is the cumulative figure. So we get the one for the current year. So this 700,000 is for 2 years. For last year alone, we have been given. So we get for the current year, which is how much here? This is 500,000. This is 700. Then we less allowable expenses. We less allowable expenses, correct? So we start with the material. So we have materials. We have materials balance brought down. So materials balance brought down for 6,000 and 4,000, isn't it? And then we have materials delivered, isn't it? Materials from store delivered, isn't it? So we have from stores, material from stores, 10,000, 14,000, isn't it? And then from suppliers, so, 100,000, 128. So that one we add, isn't it? Then we find out any other item that relates to material. So we have transfer out. Transfer how much? So 10,000 we deduct. 17. This is 17. So we deduct 17,000. 17,000. Then we have material. We have sales. Upper, dash, and the other one, 22. So we deduct, isn't it? So, and then we have the closing balances of materials. So we have balance carried down. Balance carried down. This is 40,000. This is 50,000, isn't it? So how much do we get? Excuse me. $66,000 or just 66? 66,000. The other one, this one is 57. So that is the first cost. Then we check other allowable costs. So we have materials. Then the next item from materials, we have plant purchased. Then we have subcontractors. Subcontractors fees allowable. Subcontractors fees. Nini unasema nini? Kuna nini? Kuna shida gani? Iko sawa? Kuna mtu anakuwa yuko satisfied. What is the issue? So that is 66, this is 57. So the next item is subcontractors fees is allowable. So subcontractors fee has no any adjustments. So for hospital project, it is dash, and the other one is how much? 18,000, isn't it? So rather 18,000. Then we have consultants fees, allowable, isn't it? So we have consultants fees. We have adjustments to be made. Additional information number one: consultants fees for the hospital project included 40,000 paid for the year 29. So that's a prepayment, isn't it? So the other one is not in thousand, so we make it in thousand. So it will be 40, just 40, not 40,000 to be 4. So it's 30,000 minus 40. How much do you get? It is 30,000 minus 40, not 40,000. 29,960. And the other one is 29. This is 29,000, isn't it? Then we have inspection fees. Inspection fees. This is 10,000. 5,000. That is allowable, isn't it? And then we move on to the next item. So we have salaries and wages. Salaries and wages. So this one requires some adjustments. So we have salaries and wages, 120,000. We have accrued salaries at the beginning, minus 1,500. And then at the end is how much? 4,000. Where is it? Oh, there. 1,000, isn't it? So we add 1,000. The other one is how much? 120, 180 minus 1,200 plus 2,000. So how much do you get the first one? Huh? 119. 119,500. And the other one? 179,000. This is 2,000. So it becomes 180,000. We're done with salaries and wages. I think it's not that bad question, is it? In fact, you can start with that one, and then you go to the insurance. Suppose you're the one doing that sitting. You do contracts. The VAT. Then you do 1, 2, 3 theories. Then you go to partnership. And then we go to the next item is head office expenses. Head office expenses. So how much is head office expenses? Dash and 2,000. Head office expenses. Material. Plant lease charges, isn't it? Plant lease charges. Plant lease charges, how much is it? 400. This is 500, isn't it? Direct expenses. So it is how much? 3,000 plus 1,000. Is it plus 1,000? Plus 1,000 minus 200. The other one is 2,000 plus 400, isn't it? So the first one, how much do you get? 3,800. So this one is 3,800, and then 34, 24, 2,400, isn't it? I think we are done. Then we have investment allowance planned. So let us use the current rate, which is 10%. So we have the written down value for hospital, which is 190. Then we check whether they acquired any other one during the year, plus 0, isn't it? The other one is 10% times 150 plus 120 plus 120. So the first one you get 19,000, isn't it? This one is 19,000. The other one? Huh? 27. So this is 20. And then you get the taxable profit here. So when they have not told you that a particular proportion, you just apply the tax rate on the taxable profit there. How much you get? So you can even deduct once. So long as you have written less, it means this also are deductible items. So they don't take a lot of time, isn't it? They don't take a lot of. So I believe you can take 10 minutes to do one, then we move on. So you can attempt December 2022. This one, attempt this one now, not tomorrow. December 2022, question number 4. December 2022, question number 4. So question number 4B. Attempt now, December 2022. Hapo mpata ngapi? 251, 340 na hapa. 700. 321, 700. So tax liability here, 30%. 30%. So which is going to be? Or you can combine them together, isn't it? I think the best way is to combine them together and then you tax. Yeah. 317? Excuse me. 629, 640. So 30% ya hiyo inakuja ngapi? 188. Sawa sawa. So you can attempt very fast. December 2022, attempt now. Attempt now. December 2022, question number 4B. Question number 4B. Siandike hii sana. Piga picha. Kama hajakwambia recognize profit, namalizia tu hapo. Sasa ikikuja mtanguka. Nasema hiyo shule iko na serikali. Haya. Hakuna problem. Nani amefanya? Huko na shwari kio kama utafiti. Ama na kuara. 67% umeanguka. 40%. 40%. Sasa naona kuna mtu atapata. Nafai kuwe 40% zote mbili. Sasa hata tufanye, sio? So we are doing which question is this? December 2022 question number 4B. December 2022 question number 4B. So some of us have not done it, isn't it? Most of us are not getting it. Some of us have not done it. Most of us are not. Yeah, which is very dangerous. So the question reads, Mijengo Contractors Limited is a resident firm engaged in the property development business. as at 1st January 2021, the firm secured 2 construction contracts, namely X and Y, which are to be completed within a period of 2 years. The information relating to the contract is as follows. So contract X, contract Y, contract price you've been given 22,500,000, 20,900,000 for Y. So direct cost incurred in the year, you'll be given the direct cost incurred in the year. Additional information number 1, contract X material cost include material costing 240,000 shillings that remained at the site as at that 1st December 2021. While under contract Y, material costs costing 300,000 was sold during the year. Number 2, the company estimates that cost to be incurred to complete the contract would be 150% of the contract cost incurred in the current year for both contracts. Number 3, the company computes taxable revenue on the basis of the percentage of completion method for the 2 contracts. So they have specified. And then number 4, analysis of the general and admin expenses for the year ended for the year is as follows. So we given the expenses, office salaries, renewal of the contract license, pension contribution, billboard cost and billboard erection cost, purchase of computer software, of which the software was 30,000. The total cost is 210,000. Depreciation 29,500. Subscription due to contractors association, interest on overdue loan, legal fees on defense against claim of breach of contract, rent for office premises, utilities. So number 5, other incomes received by the company included. Other incomes received by the company included interest income from Upland Bank, dividend income from Lima Cooperative Society, and royalties income net. So required, compute the total taxable income for Mijengo Contractors Limited for the year ended at 1st December 2021, 12 marks, a lot of marks, isn't it? Then number 2, compute the tax payable, if any, by Mijengo, so 14 marks. So of course, now when you're doing this paper, that one should be, you should get 14. Then there's VAT there, around 10. Which other one? Do you normally read the theories? So we'll start reading theories. First of all, okay, let us do this one first. So this is contract X, and so we have, I'm not writing the title. So we have contract X, and so we got the cost incurred to date, isn't it? Cost incurred to date. Cost incurred to date. So we are going to list them. So we have the material cost. Material. So we have materials, isn't it? Materials. This one is 2 million. So we write here shillings and thousands. And this other one is 1,800, isn't it? So we check we trace any other information on material. So contractors material costing cost include material costing that remain, isn't it? So material balance carried down, isn't it? Which it is. So this one we're going to deduct to 40. This is 300, isn't it? So that was to give us the cost of material. 2260, 1,500, isn't it? We have direct labor. Direct labor, this is 2,000, 3,600, isn't it? And then we have consultants fees, no adjustments. Consultants fees, 300, 260. And then we have subcontractors fee. Subcontractors fees, 1,420, 20 at other direct cost. Other cost, 34.5, 45 point. So we add them. This is the cost incurred to date. 60, 14.5, 74, 35.5. Estimated, then we have been given in note number 2, the company estimates that the cost to be incurred to complete the contract work will be 150% of the costs incurred in the current year, isn't it? So estimated total cost to completion, estimated cost to completion, estimated cost to completion, estimated cost to completion is 150% of this. 9021.75. This other one? 11.25. Then we get the total cost. Get the total cost. We get the total. Why? 18,588.75. And this other one? 15,036.25, isn't it? Then here we get the percentage of completion. Percentage of completion is going to be cost incurred to date, 6014.5 over total cost, which is 15036.25 times 100. This one is going to be 7435.5 over 18,588.75 times 100. So the first one, yeah, this one should be 40%. This other one, 40%, isn't it? So 44, 40, isn't it? Then we get the revenue recognized. So get the revenue recognized. So revenue is going to be 40% of, is it, how much is this one? 22,500. How much do you get? This one is 9,000, and the other one, 40% of 20,900. 83.60. Then we less cost incurred to date. Cost incurred to date. This is 6014.5. This one is 74.35 point. And then we get the gross profit. 2985.5. This other one, 94. 924. Now, because the expenses have not been apportioned, so we get the combined gross profit. Combined GP. So this one is going to be 85.5 plus 924.5, which is 3910. Then now we less allowable expenses. It is difficult to, they have not apportioned the expense, they have not given a way to apportion the expenses. So we're going to combine the gross profit and then we deduct expenses cumulatively, isn't it? So the expenses, office salaries. So office salaries, any adjustment? So we less office salaries. Office salaries, how much is it? So we deduct here 850, we can put in bracket. Renewal of contract, isn't it? License, so yeah, that license is allowable. 186.6 you deduct. Pension contribution is allowable. Pension contribution is allowable. 236. And then we have billboard, that is a capital item. Computer is also capital. Depreciation not allowable. Subscription allowable, isn't it? Subscription to a trade association is allowable. Subscription 35.68. So we deduct that one. Interest on loan is allowable, isn't it? Interest on loan, how much is it? 22. Legal fees That one is not allowed, isn't it? And then next one is rent is allowable, isn't it? How much is it? 614, yeah? Then we have utilities. 245, 2.5.6, isn't it? And then we less investment allowance. So we have billboards. So billboards, it is 10%. 10% of, is it 202? 20.2. Then another one is computer and software, isn't it? Computer, excuse me, 25% of 210,000. 52.5. 52.5, sindio? Another one. So we get the taxable profit here. Taxable profit. Then we add other incomes, sindio? So unaona sisi swali ngumu. Other incomes, interest income from Upland Bank. So that one is taxable, isn't it? Interest income is already given in gross form. 348.8. Dividend income from Lima Cooperative, taxable. Dividend income, 360. And then royalties, you gross it, isn't it? So it's going to be 100 over times 695. 732. Then here we get the total taxable income. Total taxable income here. Then now we apply 30% of this. You have your 14 marks. So it wasn't difficult, isn't it? So we have good arrangements. On Saturday, we'll be doing some, we still have tax planning and what we call anti-avoidance. So those are we can combine in one class, or we can do one now, isn't it? What is the time? If you can sacrifice 1 hour, we can do one. If you cannot, then we will do them on Saturday. We want us to do one. Yes? Yeah, so we can do anti-avoidance now. Then we will be doing some, in the subsequent classes, we'll be doing a theory. We will show you how you need to revise on theories. Theory is number one. You need to know what your theories covers in the syllabus. Then we have those notes you read, and then you identify questions. You identify questions that relate to that particular area. Maybe like, for example, we have alternative dispute resolution. You identify questions. So you read the notes, you identify questions. We have what we call tax risk, tax policies. You read the notes, and then you identify questions. Yeah, that is how we do it. So we do all the questions from 2025 all the way to around 2020, attaching to a particular topic. So now when you do that, you will do it. It's very easy. No one should fail tax. That is what I'm trying to say. So you need to attach a question and a topic. Ethics, they normally bring it according to topics. Wakileta swali inakuwaga iko attach kwa topic. Naona hiyo. So wewe pia unafaa uko una attach hiyo swali na topic. So we are going to identify all the topics that requires you to tackle using theories. So you are saying we do anti-avoidance. You are sure? I take a photo of that one. You can take a photo of that one. I give you how many minutes? We will start our class 8 or 5. 8 or 5. That is when we're starting our class. Explain yourself. So we're going to do anti-avoidance measures. We call them anti-avoidance. And the avoidance measures. And the avoidance measures, that is what we're going to do briefly. Ulifanya back duty? Ulifanya back duty? Kweli? Yeah. And the Sato? Saa 6 tu. 6 mpaka saa 5. Pone class ingine. So so right there, these are rules introduced. These are rules introduced. These are rules introduced by the tax authority. These are rules introduced by the tax authority. These are rules introduced by the tax authority to prevent the reduction of tax liability, to prevent the reduction of tax liability by legal arrangement. By legal arrangement, they include number one, shortfall distribution of dividend regulation, shortfall distribution of dividend, shortfall distribution of dividend regulations, shortfall distribution of dividend regulation, shortfall distribution of dividend regulations. Number two, thin capitalization. Thin capitalization. Thin capitalization. Thin capitalization. We used to have compensating tax, but it was scrapped, so that we are not going to learn that one. Compensating tax was scrapped. So we're going to start with the shortfall distribution of dividend regulation. Shortfall of dividend regulation. Then you write, companies are required to make the following distribution to the shareholders in form of dividend. 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 Number one, at least 40% of the operating profit after tax, at least 40%, at least 40% of the operating profit after tax, at least 40% of the operating profit after tax. B, 100%, 100% of non-operating profit after tax. 100% of non-operating profit after tax. And then you write another paragraph. Companies may be exempted from such requirements. Companies may be exempted from such requirements. Companies may be exempted from such requirements. Companies may be exempted from such requirements in the following circumstances. In the following circumstances, number one, if the company is undertaking a capital project, if the company is undertaking a capital project, if the company is undertaking a capital project. Number two, the company is servicing a loan. The company is servicing a loan. Number three, where the company is controlled by the government, directly or indirectly. Where the company is controlled by the government, directly or indirectly. Whether the company is controlled by the government, directly or indirectly. How many are they for? And where the company is in the process of a merger as a predator. Where the company is in the process of a merger as a predator. Where the company is in the process of merger as a predator. And last, where the company has no liquid funds. Where the company has no liquid funds. Where the company has no liquid funds. So if the company does not comply, another paragraph, if the company does not comply, if the company does not comply, if the company does not comply with these requirements, with this requirement, a shortfall distribution tax, in bracket penalty, if the company does not comply with this requirement, a shortfall distribution tax, a shortfall distribution tax, in bracket penalty, of 5% is imposed, of 5% is imposed on the undistributed profits, of undistributed profits. So there is what we call shortfall distribution. So 40% of profit after tax from operations should be distributed as dividend. 40% of profit after tax from operations should be distributed as dividend. 100% of profit after tax from non-operational incomes should be distributed as dividend. So we are going to compare this, the minimum, that is the minimum requirement, against the actual distribution, the actual amount paid as dividend. So if you don't attain the minimum, you are penalized 5%, isn't it? You're penalized 5%. So let's look at examples. December 2011, question number 5A. December 2011, question number 5A. So there's another question. Why do you think that one is necessary? Why can you just, there's a question that wanted the student to justify why the imposition of shortfall distribution is necessary. Supposing you have not met it, why is it necessary? 2011 iko kweli kwa hiyo past paper zenyu? Kwa nini unadhani hii tax hii requirement is important? So that the government can get revenue in form of taxes. So when the company distributes dividend, there's a tax of 5%, isn't there, on dividends. Then when the company distributes dividends, there's enough circulation of money in the economy. So they boost economic circulation they bring economic circulation, isn't it? There's enough circulation in the economy. So there's a question that was done in December 2011, number 5A. December 2011, question number 5A. December 2011, question number 5. Do you have it? So the question reads, the following information relates to the Maji Mazuri Limited for the year ended at 1st December 2010. Number 1, profit before tax, 100 million. This comprises investment income of 10 million and operating income of 90 million. Number 2, the balance of long-term loan was 50 million with an interest rate of 10% per annum. Only 40% of the interest on the loan due for the year was charged in determining the profit for the year, being the actual amount paid. Number 3, capital allowances provided for in the income statement amounted to 4 million shillings. However, the Revenue Authority has revised this amount downwards to 2 million shillings. This revision has not been adjusted in the income statement. Number 4, the total dividend paid for the year amounted to 25 million. Number 5, the company is subjected to corporation tax at the rate of 30%. So required shortfall distribution for the year ended at 1st December 2010. So first of all, you list down, we have here operating income. So we have operating income here. And there we have non-operating income. So we have those two incomes. So we have profit before tax. So you list down the income that are supposed to be taxed from both ends. So here we have profit before tax. So we've been told the combined amount was 100 million, isn't it? 10 million for this one, isn't it? And the other one, this is 90,000, isn't it? Then we have some adjustments to be made on this one, operating. So they were being told in arriving at this profit before tax, they had a loan of 50 million and they had only claimed 40% of the interest expense. So meaning they have not claimed 60%, isn't it? So here we claim here interest expense. So we claim the remaining amount that was not claimed. So it's going to be 10% of 50,000 times 0.6. 3,000, isn't it? So this one was not claimed. It means you deduct. This one was nothing, isn't it? Then in arriving at this profit before tax, they had claimed investment allowance of 4 million. So this one was revised downwardly to the adjustment was needed to be done. So how do you adjust? We add back investment over claimed investment allowance. Investment allowance. So we add back how much? So we add back 2 million, isn't it? Then here we get the profit before tax, taxable income. So we get your taxable income. So here it will be 10,000. And here, 89,000. Then now we less tax at 30%. Dividend tutaangalia 30% nakuja ngapi? 26. So 26,700. This is 3,000. And then here we get profit after tax. This is 7,000. And this one is 62,300. So this is the minimum distribution. So the minimum distribution, they're supposed to distribute 40%, and here they're supposed to distribute 100, isn't it? So dividend, the they are supposed, the dividend payable, the one that they're supposed to pay. So this one is 7,000, and this one 24. Are you following? So now total minimum distribution, total minimum distribution. It should be 24,920 plus, which is 31,920. Then actual distribution, 25. So shortfall of how much? 69. So 69.20, isn't it? So that is the shortfall. So they distribute dividend less 6,920. So here we have shortfall distribution tax. Shortfall distribution tax. So itakuwa 5% of 69.20, which is 346. Sawa. So I want to do one and then you attempt one. I do one and then you attempt one. Sindio? So, Sindio, November 2014, this is the one that I'm doing. November 2014. Is it May or November? May 2014, sorry. Question number 4C. May 2014, question number 4. May 2014, question number 4C. May 2014, question number 4C. May 2014, question number 4C. May 2014, May 2014, question number 4C. May 2014, question number 4C. The question reads, the following details were obtained from the income statement of, is it Jamila? Jamila Limited for the year ended at 1st December 2013. So we have been given the incomes. We have been given dividend from Maziwa Cooperative Society Limited, 136,000 net. Dividend from Biashara Bank Limited, 42,750. Interest income from Post Bank Limited, is it 94,000? Interest income from deposit in other banks, 60,000 gross. Foreign exchange gain, rental income, insurance compensation of stolen goods, gain on forward contracts, interest on deposit with a foreign bank, operating profit before other incomes and taxes, distribution, isn't it? So required shortfall distribution, dividends, and shortfall distribution tax. So first of all, you list down all the taxable income, first of all. So here we have operating income, and this one is non-operating. So the first income, dividend from Maziwa Cooperative, which kind of income is operating or non-operating, or taxable, non-taxable? So you first of all categorize it as non-operating or operating, and is it taxable or non-taxable? Non-operating taxable, isn't it? So dividend cooperative, so you write here dividend, that is dividend cooperative, isn't it? So that one we are saying it is non-operating taxable, isn't it? But we gross it. So we're going to gross it. So we're going to be 100 over 85 times 136,000. So how much do you get? 160,000. So that one is going to be 160,000. We go to the next income. Dividend from Biashara Bank Limited. Non-operating, not taxable. Dividend from companies, the withholding tax of 5% is fine, although distributable, though we are going to distribute it later on. Sindio? Ama yun taxiwa. So we shall tax withholding tax. We don't subject it to 30% again. Sindio? So we go to the next income, interest income from post bank. Non-taxable, non-operating, isn't it? Although distribute. Sindio? And then interest income from deposits with other banks. That one is taxable. Interest income is taxable, sindio? Interest income kwa kampuni zinakuanga taxable. Apart from here post bank. Interest sio inakuanga taxable. Kila saa tunaandikanga hapo interest income. Ni ngapi? 60. So wametupatia gross, sindio? So we write there 60. Tumeelewana? We're done with that one. And then we have foreign exchange gain. Operating taxable, isn't it? So right here, foreign exchange gain. Ngapi? 48,000, senior. So this one is the dash. Foreign exchange gain. Then we have rendo income. Non-operating, isn't it? Taxable, senior. Rendo income. Ngapi? 460? 460,000. Sinikweli? Yes. And then we have insurance compensation on stolen goods. Operating, isn't it? Taxable. So we have insurance compensation. Insurance compensation. How much is it? 240. Your dash, isn't it? Gain on forward contracts. Operating, isn't it? So gain on forward contracts. Going on forward contract. You know what that is? So how much is it? 84,000. This one is dash. Interest on deposit with foreign bank. Interest with deposit with foreign banks. Non-operating, non-taxable. Foreign interest is not, interest from foreign countries is not taxable. And then we have operating profit before. Profit before. So we have profit before tax. How much is it? 4,200,000. And then we have, so that is, isn't it? So we got the total taxable income. Total taxable income here, total taxable income. So we add. Which one? 45, 72,000. This other one, 680. So this one is 680. Then tax. Tax at 30%. 204,000. This other one, 1371, 600. And then here we have profit after tax. Profit after nakuja ngapi? 32,400, 32,00400, isn't it? And the other one, 476,000, isn't it? That is profit after. Then you add here other incomes. These other income that were not taxable, they're still distributable. Sindio? Although not taxable, but distributable. So number one, dividend from biashara. Dividend biashara bank. CO, it was withholding tax fund. So but the amount is supposed to be distribute 100% of it, which is how much? 42,750, si ndio? 42,750, si ni kweli? And then we have interest post bank. Interest post bank ngapi? 94,000. And then foreign interest foreign bank. How much is it? 148. And then we get the total distributable income. Total distributable income. This is 32,00400. This other one. 760, 750. Then here we have minimum distribution. Minimum distribution, here it is 40%, and the other one is 100%. So how much you get? This is 40, this is 760, 750, and this other one? 1280. 1280, 160, is it here? So that is so here we have total minimum 180, 1280, 160 plus 760, 750. Akupatia ngapi? 2049 actual 290, 660. Is it 660? It's okay. Shortfall 1750 to 50, isn't it? Shortfall tax 5% of 1750. 8745. Sawa sawa. Aya, hii swali ni rahisi tena ni ngumu. Acha tuone kama nyinyi mnaweza. Unajua tunaweza kuwa tunaenda mbele na huku nyuma bado kuna nini inaitwa aje? Hizi vitu zinakuwa kwa mimea ukishapanda inaitwa nini? Magugu. Sasa acha tuone. So nataka hii ndio utafanya tu, ukifanya hii tunaenda home. Hiyo nyingine ni rahisi sana, tutafanya weekend. So jaribu hii August 2024. Saa hii hata ichukui muda mrefu. Nyie mfanyangi assignment. Nyie mfanyangi assignment. Sijaona mtu amefanya assignment hapa. Bado. Saa hii ndio sawa. Nyie mfanyangi assignment, si ni kweli? Tutafanyia kwa exam. So hii ni August 2024, question number 4B. August 2024 question number mtajaribia home, si ndio? So hiyo nyingine tutafanya Saturday tukifanya tax investigation. August 2024 question number 4B. So jaribu hiyo. August 2024 sawa.
Uza.